Started. Punching in live. All right, everything looking good. Should be coming off live on that end. Let me know if you can hear me in the chat. All right, looking good. Welcome back to the channel, Crypto Trend Trader, with our Sunday evening market look ahead. It is 8 p.m. Eastern Standard Time on February 6, 2022. Before we get this party started, I would like to remind you, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. MHoff13, what's up, brother? Says, great content. Looking forward to joining the group shortly. Getting my request in early. Could you look at Adam, Algo, and Link? Yeah, just remind me when we get to the crypto thing. I didn't want to load up a bunch of windows just because I've been having some issues with TradingView, just like randomly crashing and like losing all my charts. So I'll just switch through them when we get there. Just remind me, all right? And then what's up, CW? Good to see you. That's right. Smash up those like buttons. You guys can hear me loud and clear. All right, let's go ahead and get it started. What's up, Asotos? All right, so before we get started today, there's quite a bit to talk about. Obviously, this is a big week coming up here. I know there's been a lot of like pivotal weeks and moments and all that stuff going on, but this is a seriously big week. We have basically, we had the breakdown that we were expecting in traditional markets, showed some weakness. Obviously, crypto's been trending down for some time, as expected. We pointed out some bullish divergence on the crypto chart on the daily, and we've been basically waiting to see, was that going to play out, or were we potentially going to get a third drive lower of daily divergence? We obviously had a descending resistance trend line. We broke out of that trend line going into the close on Friday for the futures market, and then all weekend crypto literally did nothing. That to me was a huge missed opportunity. I felt like that was a forced breakout that would then allow basically a potential weekend pump, and we saw no follow through. And then we basically just saw, a failed pump throw over right at the end of the day. And then we literally just saw it happen again. We saw a pump, a close on the 4 hour, a close on the daily, confirmed breakout of a new high after just going sideways for days. And now we basically just had 3 bearish candles, come back down and essentially engulf it on the shorter time frames. So at this point in time, we look like we're about to get a 4 hour cross back down. It doesn't look great. We'll see what happens. If this area holds, I actually like how the spot market chart looks right now, because the 821 on the daily are crossing back to the upside. So even though we're underneath the 200 moving averages, there's still some potential. Now the CME futures chart is not nearly as bullish, but we'll get to all that. I want to actually start off though with what I consider to be right now the most important thing. We can talk about, all the different indexes. We can go into all the different technical analysis on all these different charts. We can look at the dollar. We can look at gold. We can look at all that stuff. But in my opinion, the most important thing to watch right now, and what I'm literally eagle-eyed on, is, well, we'll start with the 10-year treasury. So obviously you guys know I pay close attention to the 10-year treasury. We've been talking about this for quite time, following it. Basically called the bottom back here, switched bullish when we got back on top of the 200 exponential and simple on the TJD master. We've been sloped to the upside and trending powerfully to the upside. We cooled off for a little bit here. The 200 simple crossed above the 200 exponential, showing a little bit of weakness in the trend. We now are about to cross the 200 exponential back above the 200 simple. Obviously, both still have a blue slope. And then this happened. Not unexpected by any means, as we've been basically predicting, anticipating, waiting for this breakout to happen. Because all this is This is just the measure move. This is the beginning of the measure move after confirming the breakout. So we basically have a left shoulder, a head, and then a right shoulder for an inverted head and shoulders. Or if you don't want to count this left shoulder over here, we have a massive cup. We have a retracement, which is a descending channel. And then the breakout of the channel is the initial move up, and that forms the handle of the cup and handle. And then the measured move breakout of the cup and handle is the, I'm sorry, that was the wrong one. I meant to grab the blue one. The measure move breakout of the cup and handle is, maybe I just have random stuff here. I don't know. I should have, oh, here, maybe this one? I don't know. There's so many arrows drawn all over these. Some of these charts are getting pretty old here. So this, we'll just use a new one. We'll just draw a new breakout for the cup and handle. There we go. So the actual breakout is from the bottom of the cup itself to the neckline break, and that will be like our actual measure move breakout of that. So now, after we look at that, we have basically broken through, whether you want to call this the inverted neckline right here, whether we want to call it the neckline or the top of the cup, where the handle meets the top of the cup, and that is like basically our resistance. So now we've broken through that, we consolidated above it, and now we would expect our measure move breakout to occur, one of many measure move breakouts to occur. And essentially that's going to give us some of these potential targets to the upside, which obviously we have our fib target in yellow here from the top to the bottom, and we're headed first to the 786. So that is our initial target at 2.0%. Then after that, we can start looking at like the 886 at like 2.57, the top of the range, which is our actual, massive range that we've been trading inside of, all that stuff. So we can start looking at those moves as we start breaking through key levels. We can start paying more and more attention to that stuff. But more importantly right now is, this has been a pretty consistent overall trending move to the upside. We haven't seen too many like massive violent candles along the way. They've all been pretty, relaxed around the same size. We see some pushes up, we see some pushes back down. This is an outlier in my opinion, with the exception of basically the trend starting moves where we see basically one big pump and then a trend follows. One big pump and then a trend follows. One big pump and then the trend follows. This is different because now we're seeing a breakout above a highest level, 2 cycle highs, and then we're seeing this after we've already been trending to the upside. Obviously the Fed has a meeting coming up. They obviously have indicated that they plan on hiking rates. This is the 10-year Treasury yield, and now we're at 1.93%. And you guys know that one of the main things I pay attention to is the 2 and 10. The 2-year and the 10-year, and I pay attention to the yield curve inversion. And I've been talking about this for months. This is how we've predicted the last recession and many other, recessions in the past. It's one of the 4 things that I always talk about, always pay attention to, always focus on. Well, we've already noticed that mainstream media is no longer showing us ever on the same chart the 25 or the 20 and the 30, because we're already seeing yield curve flattening and inversion on the high end of the curve, meaning that people are less likely to tie their money up for a long period of time if they don't get paid extra for the risk associated with that excess amount of time. They just take the shorter duration. So when we start to see that happen on the top end of the curve, the yield curve flattening, that implies that people are going to keep getting pushed towards like the center or towards the bottom of the curve. And then eventually what happens is you end up getting paid more for shorter duration bonds than you do for longer duration bonds. So there's no longer an incentive to tie your money up for a long period of time. So that's why it's so important for us to pay attention to this 2-year, 10-year curve. And this right here is the cost of money. We know that. We know that the Fed funds rate, or, whatever, this is the risk-free, market return that you can get. And we know that in order to be positioned in like something like the S&P, which is considered to be your safest stock bet, you can get a dividend percent of like 2.5%, basically. Pretty standard in the S&P. And then on top of that, you can also make gains based on your actual principal and like the rise of the S&P. So anything less than 2.5, you're more likely to just put your money in the S&P. You're more likely to just play risk on than be involved in bonds. And we know also that if our shorter duration bonds are paying as high of a yield as our longer duration bonds, we're more likely to be in shorter duration bonds. So that means that if we go over what the S&P would pay us in a dividend, and the shorter duration bonds are paying a higher percentage yield than the longer duration bonds, then that's going to basically make people want to be in short duration bonds. So money's going to come out of long duration bonds. Money's going to come out of the indexes, and then we'll see it either in cash or in shorter duration bonds. So what we have to be careful of is it basically turns into, a self-fulfilling prophecy. So even if the Fed decides, oh, we're just going to hike this much or that much or whatever, the market starts hiking for them, starts anticipating their move, looking forward, and then positioning itself accordingly. So now I want to go to another chart, and then we'll do our regular technical analysis and everything like that. But I really want to focus on this because this is super, super important. And not enough people are paying attention to this, or they're mentioning it under their breath because they heard somebody else say it, but they're really not looking at it. They really don't understand it, or they're not correctly, showing it off. Most people really probably learned about this in the last few months. Didn't even know what it was previously, and now they've just heard a couple of people talking about it, so they're talking about it too, or they're drawing a couple of pictures on a whiteboard, or a couple of graphs on a chart, or they saw somebody else pull up the Fred data, so they're looking at it. So let's really look at this. Let's really look at the 2 and 10 and see what's going on here. So what I have here is the 2-year treasury, and this is the constant maturity rate on a monthly chart. So all this is this is the yield on the 2-year treasury. So if we just see, obviously it's basically been trending down since it peaked in 1981. So we know what happened around then. We had, hyperinflation, we had Paul Volcker raised rates, and then since then he basically killed inflation, and we haven't had inflation since. And we've been in this downward trend the entire time. And now for the first time since the 80s, since really, the 70s is when the issue really started, we're now having massive amounts of inflation. So we see that the intensity of this downtrend has been getting more and more intense. And then we basically reached zero down here. This last little crash, we got down to like 0.11%. So, that's about as close to zero as it can get. So now if we just put on our drawing tools here and we just draw in a basic descending trend line, we can see very clearly we have one touch here. We don't quite make it to that trend line right here. And then we have another touch clearly here, a couple more right here, a clear touch right here. And we're pretty close. We're inching our way up there right now. So we're closer to the trend line than we are to the bottom. That's a fact. And then each one of these white lines that I've drawn in right here, these vertical lines, is a recession. So every time we basically tag this trend line, or almost tagged it in this case, we then had a recession almost right afterwards. We peak, we roll over, we go into recession. So we're headed up at a parabolic angle. And we know for sure that in order for a downtrend to continue, that we need to have this peak come in lower than this peak. Because if this breaks out above this peak right here, we know what that means. That means just like what happened on Bitcoin, we've broken out of a descending trend line and the trend is no longer to the downside. So the trend that's been going on since 1981 and now we're in 2022, it's a 40-year downtrend. So we know we're at 1.19 now. We know the previous peak was at 2.91. So we know that if we creep back up here another, 1.62 on the yield for the 2-year, we're in trouble. Now, granted, this is a monthly chart just to make it more clear. So that's not a big deal. It's still a little ways up here. We have the trend line close to like 2.26. So we still have a little ways to go. Not that big of a deal. So now let's turn this back off here. We'll turn off our drawing tool. We're going to turn on the TJD master. Okay. So now here we see the 200 exponential and simple moving average on the monthly, basically coming in around the same area as our trend line that we drew in. Here we kind of overshoot it a little bit, but we see we've been in a pretty strong downtrend the whole time. We had a short period where we flipped it to the upside here, or at least neutral. But we see the 8 and 21 here build an upside move right here and then get rejected. One here and then kind of go sideways, and then we finish that move out. And then here we have a trend to the upside where they flip green on the monthly. Here we have one that flips green on the monthly. Here we have one that flips green on the monthly, and this is our current move. So now if we turn our drawing tools back on, we'll see once again that, we basically run up into the recession right here where it's green. We have this little nub right here, and then another recession right here. And then we have, basically a push up, don't quite get there, kind of go sideways, and then we get there, recession. This one, recession. This one, recession. So now we're pushing up right here, and one of two things going to happen. Well, I should say one of three things is going to happen, but really two of them are the same thing. We're either going to roll over before we get up here. This is going to be a fake out, and then we don't have a recession. That's one. Or two, we push up here and we top out and have a recession. But 2B, that's 2A, is we push up here, we top out, and we have a recession. 2B is we push up here and we take out that previous high. And not only do we have a recession, but we break out of a 40-year downtrend, which is not good for bonds, not good for probably the world at that point in time. All right, so we've established a couple different things. We know what that looks like. We know what they're telling us. We know why they're important. We know what we're paying attention to. We know what we're looking out for. So now let's look at something else. This is the 10-year on the same monthly time frame. And again, we see very clear downtrend. So I'm going to turn on our drawing tool. Once again, we see very clear downtrend. Peak recession, don't quite get there, recession, peak recession, peak recession, peak right here. This was our recent recession. Okay? So now let's put those together and see what happens here and see if we can determine a predictor and then eventually try to figure out exactly when we would predict that there's potentially going to be another recession or breakout. So now I turn back on the 2 years in blue, and then we know the orange here is the 10-year. So we see here, this was the cross recession. This, it almost crossed back up again right here and then just got rejected off that trend line. Here was a cross recession. Here was a cross recession. Here was a cross recession. And then push all the way back up here, rejection. Here's the cross recession. And now we see what's about to happen right here. We know what happens every time this blue, every time the 2 year closes the gap on the 10-year. We know what happens. We top out and we have a recession. So how far are we away from that happening? I mean, the 10-year is right here. So what's the 10-year going to cruise up another, 0.5%, 50 basis points, and then top out? I mean, if it goes higher than that, we risk taking out the previous high. The 2 year is accelerating exponentially faster. I mean, look how long it took to cover the distance. This was a 10-year, went from 0.55 to 1.82. This was a 2 year, went from 0.11 to 1.19. So this one is accelerating exponentially faster. So if we just use our drawing tool and we just kind of predict, something like this, which is actually like kind of cooling off a little considering the angle that we're in, and we turn that one blue, and that's our hypothetical line for that one, and then this one just kind of does its thing right here. I mean, how far are we away from this recession? I mean, it's not long. I mean, this isn't a direct science or anything, but that's November 22nd or November 2022. And that's assuming this kind of cools off a little bit. I mean, if it doesn't cool off a little bit, if we get the straight up aggressiveness that it's already doing, I mean, when is that going to be? That's basically April 2022? So if we're not lucky, it's April. If we are lucky, it's, October, November? I mean, I don't think people understand how close this is to happening. And people are talking about, oh, the Fed can't raise rates. They're trapped. They painted themselves in a corner. The Fed doesn't have to raise rates. The market's doing it right now. We see it. We see it happening right now. We see how close we are every other time, how close we were, and we see how close we are. So when is going to be the next one? I mean, I don't know. I don't know for sure. I can't tell you 100%, but I mean, it looks like somewhere right around there. And that's if we're lucky. If we're not lucky, it's right here, right here. I would say by the middle of the year. So, I mean, we'll see what happens. We can't assume. We don't want to jump to conclusions or anything. But we see very clearly we are accelerating towards that point at a very aggressive slope right here. And, essentially what that tells us is, we can put all of it on at the same time. Essentially what we see is every time we saw this happen, we tag the line, we get the cross. We don't quite tag the line, we get the cross recession. Tag the line, get the cross recession. Tag the line, get the cross recession. Tag the line, get the cross recession. And, I mean, when is it going to be? You know what I mean? Probably by the end of the year. So not only do we see, in the history since the 80s, we've never had two recessions this close together. But we see it's essentially like unavoidable at this time. I mean, these were the closest two we had previously together. And that was 2000 and 2008, 2007. So they were like 8 years apart. I mean, this one was in technically the end of 2019, beginning of 2020. So let's say the end of 2019. And now we're talking about having another one in 2022, 2023. 3 or 4 years apart, basically. That's not good. And all that extra trillions that we pumped in, all the extra. I mean, it basically just tells me, whatever we're doing now is not working anymore. So we got to really be careful. And that's why I'm so just casual, nonchalant lately about jumping into quick little trades or taking extra positions or whatever. Because this looks absolutely horrendous to me. And, at this point in time, it looks like an inevitability. The real question to me is not if and when we're going to have the recession. The real question for me is, are we going to move up here and put in a lower high and then have a recession? Or are we going to move up here, break out, and then, that's a depression. In my opinion, that's probably a full-on meltdown depression. So we'll see what happens. But but we know for sure everybody is really worried about hyperinflation. You remember way back when we were talking about supply chain constraints. And everybody else was talking about, no, it's the money they're pumping out. And supply chains aren't the issue. And this, that, and the other. Well, are you sure? Why are used car prices going up so much? Because you can't get a new car. Why can't you get a new car? Supply chain issues. Why are all these other goods and services going up? Well, goods went up because we closed the economy so you couldn't buy services. So instead of people going out and buying services or purchasing services or providing services, people just went out and spent the money that they got from stimulus on goods. So the price of goods went up. Stocks went up, speculative assets, houses, because there was no services to buy. And we all know that if you get locked in your house for a whole year and you normally go out to eat twice a week, all of a sudden you're back to normal and you can go out to eat. You don't have pent-up demand from that whole year of twice a week going out to eat. You don't go out and eat 100 meals all of a sudden. You don't go out to 100 dinners immediately. No, you go back to doing what you're doing before. Maybe you go out 3 times a week a couple times. But that pent-up demand doesn't transfer back into extra demand the same way that it does, in some other situations. So we need to pay attention to what's really happening right here. And do we go into let me put it this way. I'm much less worried about hyperinflation than most people are. And it's not just because I'm detached from society or whatever. I mean, I'm not saying that there won't be more inflation into the future. But let's be real. And I also don't like the idea of removing statistics so that they fit your agenda or whatever. So I don't want to say like, okay, remove housing and remove used cars and then see what inflation is. Because that's not fair either. But let's be real. If you live in a house that you own or already rented, and you didn't have to rent a new house or buy a new house, and you have a car, you didn't have to buy a used car, well, then you could legitimately say, okay, well, let's rule out housing inflation and let's rule out used car inflation, because neither one of those mattered to me, because I didn't move into a new house. I'm not renting a new house or apartment or whatever. I didn't get a used car, so that doesn't affect me. So when you take those out, like, I mean, is inflation really that bad? Like, I mean, I get it. Certain things you can go through and say, ground beef's up 50%, gasoline's up 50%. But are they up just from all-time lows that they've ever been at? Or are they up like 50% from like a couple years ago? We just got to really be careful how we're looking at this. Because it's easy to pitch these narratives. And once everybody gets on the narrative train, everybody starts believing it. If we go into another recession, are we going to have inflation or hyperinflation in the middle of a recession? Or if we go into a recession, and this is another big one. People say, oh, well, wage gains. And you're like, okay, what about them? And they're like, well, once people are getting paid more money because there's shortage in the labor market. So once they come back to work and now they're getting paid more, you can't just pay those people less money. Now they're making more. And then they go and buy stuff. And then that drives up the prices on stuff. And then it's this self-fulfilling prophecy of inflation. And then the producers raise prices. And then all the goods go up. And then they have to pay the people more money or they'll go get a better job. And then hyperinflation. Sure. Or the economy starts slowing down and the people who own businesses say, hey, we're going to have to let you go. And you're like, wait, why? I thought I was doing a good job. And they're like, yeah, we're slowing down. So we got to either fire you or we're going to replace you with this guy who we can pay half as much because we need to save money. So now you have a choice to either be fired or to make half as much, probably less than you were making to begin with before you got the raise. And that's if you're lucky enough to even keep your job. So the argument that, oh, you can't just pay people less money. Once you give them a raise, it never goes away. It's sticky. The inflation's forever. Just use your brain. It's so easy to just think past all these narratives. And that's the most important thing to do, is for us to just think past what everybody else is talking about. Because they're always wrong. Whenever you hear mainstream and everybody talking about something, it's always too late. It's always already done. Now, does not mean we're not going to see the residuals of inflation play out over the next 2 months, 6 months, year, whatever. But the fact of the matter is that's just because the data is lagging. It doesn't mean that we're going to see continued inflation into the future. It just means that the inflation that's already in the system is going to take a while to work its way out. So this is why I'm so casual about the markets right now, and I'm not looking to just like dive back in and like dollar cost average and buy the dip and all that stuff. So while we're at it, we can just look at the let me jump in chat and see if anybody has any questions or anything. All right, sweet. Looks like you guys are doing fine. So yeah. CW says I can hear you in Florida. Nice. Okay, so DXY, still very clearly in an uptrend on the daily, above the 200 exponential and simple. Just put in a cycle high, having a nice little retrace. Most important thing, like we've been discussing, is we just keep putting in higher lows. Now, we could look at these as our higher lows, and that's fine. But realistically, this technically is all just one swing right here. So I really don't care how low we go right here. I mean, I don't want to compromise 200 exponential and simple like slopes. But essentially, as long as we don't take out this low right here, I'm fine. I would like to see the dollar cool off a little bit. I don't know how much it's going to cool off. I don't know what's going to happen. We have some pretty strong support around like 94, 95. If we start looking out to our longer time frames, we basically came back down, retested the 200 simple. We could easily come back down as low as like 94.28. That would be the 200 exponential. After that, it starts looking a little sketchy on the weekly. And then on the monthly, we could technically come all the way back down to like 91.3, and it would still look fine. So in all reality, this low is all I really care about. But this still looks very bullish to me. We don't want to see the 821 cross back down on the monthly. We don't want to see these 200s get violated on the shorter to midterm timeframes. But, you know, there's not a lot that's going to upset this trend anytime soon, especially if I'm right about yield curve inversion and all these other things going on. So, okay, so let's take a look at, so we already looked at TNX, so we know what bonds are doing. We don't need to look at them. Let's look at the VIX. So we talked about this VIX. We've had a descending channel for quite some time. Bottomed out here off of our green line support. So now we have a low, a higher low. We have a high, we have a higher high, we have a third higher high. We're inside this ascending channel now. Inside of our, whatever color that is, bluish, turquoise, whatever box area. So the most important thing to do here is to just continue putting in higher highs or higher lows. So we have a low here, we have a low here. We would like to just see this put in a low somewhere in this area right here. Maybe it already put in its low at the heart line of our horizontal channel. And the 200 exponential are simple. Maybe it comes down just slightly lower. That's fine. I mean, this was sort of a predictory box, but anywhere around this area is fine. And then we would expect a continuation to the upside. And we know that whenever we see these big spikes into the red zone, we know that that corresponds with a powerful market crash. So this was like 2019, 2020. We could look back here. Let me switch time frames. Just going back to the weekly, we could switch back here. We know this is 2008 global financial crisis. We know this is like the 98 to 2000 range in here. So we don't want to see it get into that red box area. We had a couple other little like touches here. Obviously, this is just showing volatility, but typically the volatility is going to come with a move to the downside. So for the record, though, this does look toppy right here. So I would not be surprised to see the VIX cool back off and this was a failed breakout. But everything else is kind of pointing us in the direction of inevitability. Timing is not important, not nearly as important. Like the old saying says, like, I'd rather be 1 month early than 1 day late or whatever. So U.S. oil, obviously still powerful, trending to the upside. New local highs, very powerful uptrend here. Definitely getting up to sort of exhausted levels. We have clearly, let me extend this out a bit. I'm going to delete this out of the way there so we can see a little more clearly. Let me turn off the moving averages too. Delete this fib. Couple of these boxes. Just kind of clean this up a little bit so we can have a little more clear of a picture of what's happening here. All right, so we've been operating inside of this ascending broadening wedge. Matter of fact, let's go to the weekly as well. Give us a little more clear of a picture. Okay, so we've been operating inside of this ascending broadening wedge for some time now. So this was our initial peak right here at a key fib level, and then we put in the bottom, and then we put in our second point, and that's been acting as resistance since then. And then again, we came back down to a key level, put in our support, and that's been acting as support since then. So we have 1, 2, 3 touches on the top, 1, 2, basically 3 touches with the wick on the bottom, ascending broadening wedge, and we're back near the top of the range now. So is it possible this is the breakout? It is definitely possible this would be the breakout. We just go absolutely parabolic. Oil goes up to like 112. Well, I mean, first 100, then 112, then 120, then a gazillion dollars a barrel. More likely than not, though, we're probably topping out around this area. So we'll have to see. We did have previously 1, 2, 3 drives of bearish divergence. Now this is the weekly, and this has technically started to invalidate that bearish divergence, which is fine. That's totally a possibility. That's okay. We also have 1, 2, 3 drives of bullish divergence. So we basically have the trend, bullish and bearish divergence taking place at the same time. So if this continues to the upside or even just goes sideways from here, we can invalidate this drive of bearish divergence, and then we'll look back at this one, but it'll look good, and we'll probably get the breakout. But if this were to just start rolling over right now, this will adjust throughout the week, and we could still have that bearish divergence validated. And then we see here we have 1 drive, 2 drives, 3 drives, and then potentially a 4th drive. We would have to once again take out that 92 level on the jewel thief, or else we will get a 4th drive of bearish divergence. Because our price is higher, but our indicator is lower, saying once again that the trend is unsustainable. So the fact that we're potentially putting in another drive of bearish divergence at the resistance line on a weekly, very close to a key Fibonacci level at cycle highs, tells me we're probably going to top out here soon again. So, it doesn't mean it's the end of the trend. Doesn't mean we're going to go to, Cathie Wood targets of like $3 and $12 a barrel. But, we'll probably come down to somewhere, maybe this time like $70. We'll see. But more than likely, we'll continue to operate inside of this ascending broadening wedge until we break. Will we break to the upside? I don't know. Will we break to the downside? I don't know. But more likely than not, we'll probably just fill this out and come back down once again. Clean this back up a bit. All right. And obviously we're getting kind of tired. We're at like those higher levels, so. Let me take a drink real quick and then we'll keep rolling. All right, so the Dow Jones on the daily, we came down initially, tested the 200 exponential and simple, came down again. We violated the 200 exponential and simple and retested those lows. We got to bounce back up, reclaim the 200 simple, and then had an indecision candle. We did not cross 821 back to the upside on the daily. The most important thing right now is we have this high. We don't want to put in a lower high. So we need to just chop around, and then we need to push up here and put in a new high. Because if we do not, this is going to look like the beginning of a downtrend. Because then we'll have a high, a low, a lower high somewhere in here, and then we'll come back down and resweep the lows. And we know that every time we touch a 200 exponential and simple, we expect to get a more powerful bounce. So this time we hit it, we put in a new all-time high. This time we hit it, we break through it. We reclaim it. But if we hit it again, it's less and less likely to act as support the more times we hit it. And we know that once we break under this, then we start threatening a bear market for the first time, basically since the CVD bull market began. Dow Jones still looks okay. We're building momentum. Still looks all right for now. All right, so the S&P next. So again, we came down here. We bounced to 200 exponential and simple. We reclaimed it. We have to just be careful here. We're not getting as clear of a picture on the S&P. Still looks okay for now. Doesn't look great. Doesn't look terrible. Next, we have the Nasdaq. This is where we start to see the true weakness in the markets. We have broken down, hit the 200 exponential on simple, got barely a bounce, broke down below them, got a reversion to the mean play, and now we got rejected. So now we're below them, and they're flipping bearish. We already technically flipped them bearish. The 200 simple kind of curved back up, and we got to push back to the upside. If we stay below here long enough, they will flip back over. This will be our reversion to the mean, retest of the breakdown. The same way we push down here, it acts as support the first time. But if we come back down to it again, it breaks. If it acts as resistance the first time, if we come up to it again, maybe we reclaim it. If not, we probably break through it. And then that confirms basically a bear market on tech, which, obviously 90% of tech is already confirmed in a bear market. We just have 4 stocks not in a bear market, and then everything else is bearish as hell. So the Russell looks terrible, obviously. It has been looking terrible forever. This was definitely our canary in the coal mine. Very clearly in a bear market, 200 exponential and simple have rolled over. We broke down from our ascending horizontal channel. We got the measured move perfectly. This was our measured move, anticipated. It played out. We got it. We hit our box area. We got the initial push back up. Could it easily push back up higher and get as high as like 21, 27 or so? Sure. Is it likely? I mean, this thing is so weak. I wouldn't be surprised if it literally just started bleeding out again. Small caps look terrible. So we know we were in a bull market the whole way up here. We know now we're in a bear market. So the next real target to the downside is 17.17. Next potential target to the upside is 21.33. So if our target back to the upside is 6%, and our target potentially to the downside is 13.7%, we know that there is a 2-to-1 risk-reward ratio to the downside right now. So if we were going to bet based on what the Russell is doing, we would bet with a 2-to-1 risk-reward ratio to the downside, saying essentially that if we flipped a coin and we were right, we get $2, but if we're wrong, we lose $1. So that's a favorable bet to the downside. Even if it has a 50% chance, like flipping a coin, of playing out to the up or downside, we know now that the likely target to the downside is favorable by twice as much as likely target to the upside. So if we were, say, mixed on how we felt about the market, we might take a position to the downside on the Russell, the underperformer, and a position to the upside on something like the Dow Jones or possibly the S&P, the overperformers, and then whichever one played out correctly would overcompensate likely for the one that we were wrong on. So the S&P or Dow would likely perform higher to the upside, and the Russell would underperform to the upside if we get a move back to the upside. The same way that if the Dow or the S&P were to break down, it would likely underperform to the downside or have a smaller drawdown in relation to the Russell, which is already the weakest. So that is a way that essentially, like a hedge position of a long and a short could be favorable at the same time in the stock market based on, basically you're betting on the winning horse to win, or you're betting against the losing horse to lose. So if the winner wins, you do well, even though you bet on the loser too. But if the loser loses, you win, even if the winner doesn't win. So, sort of a weird analogy, but essentially that's how like hedge funds kind of look at this type of thing. So it's important to kind of get that, understand that, and see how you could bet both to the upside and downside and be right either way and still make profits with an equal size position in either. Obviously, it's not financial advice. I'm not your financial advisor. Markets are extremely volatile. Please do your own research and trade responsibly. So yeah, that's it. Russell looks like trash. Got it. Okay. So gold's still doing nothing. Just basically going sideways. I mean, we're all but flatlining at this point in time. Again, same exact thing we've been talking about. The blue line and green line are acting as support. The pink line is acting as resistance. Every time we tag the pink line, we get rejected. Sometimes we bounce the blue line. Sometimes we go slightly lower to the green line. And then right smack through the middle is, the 200 exponential and simple. Just going sideways while we try to make up our mind. And then silver. So silver, we've had this sideways channel forever. We broke down from it and reclaimed it a couple times with some little janky inverted head and shoulders. But each time we have gotten rejected at a lower high based off of the 200 exponential and simple. Silver is confirmed in a daily bear market and trending down. So if nothing changes with silver, we know that it's just going to keep putting in lower highs. So maybe our next push up here brings us back to like 23, 24, and then we get rejected again. So if nothing changes, more likely we get pushed to the downside. Now we're trying to reclaim the bottom of this channel, which acted as resistance when we broke through, but we were able to reclaim it. Acted as resistance, then support, then we're able to reclaim it. So here we are again. It's acting as very clear resistance. If we don't reclaim it, we have to be careful because the measured move would be essentially, I don't know why some of these measured moves are so far off. It's got to be. We'll just blame it on a TradingView update. That's what I'll blame. I'll blame everything on TradingView updates. It's been so damn janky lately. So if our measured move is going to be this channel, all we do is just take from the top of the channel. Come on. What the hell is going on here? All right, it doesn't matter. From the top of the channel to the bottom of the channel, our breakdown is basically going to take us down to like that $18, $19 price target, which just so happens to be a previous filled level in orange from our all-time high too low. And again, I'm not going to show you the big cup and handle pattern that's been going on for 1,000 years in silver, back since the Roman days, and price targets of $1 gazillion in silver. Because let's be real. I mean, if I had a bet on the, what do they call it? The gorillas, the silverbacks. If you literally were like, hey, do you want even money on silverbacks? Or what was that movie? Planet of the Apes playing out? Which one happens first? Silver hits new highs, or hyper intelligent monkeys take over the earth? Honestly, at this point in time, I would probably take the monkey scenario. So, it could go either way though. It's probably a coin toss, but I would say probably monkeys inherit the earth and like rise up, start using tools, create their own society. You know, maybe a leader emerges amongst them and gains the ability to speak. I don't know. I mean, but 50-50 probably. But that's speculation. That's not technical analysis. Uranium looks like it's rolling over. So still very bullish on uranium long term, but it definitely looks like it's rolling over. I mean, we're below the 200 exponential. It has rolled over. The 200 simple is basically flat at this point in time. We try to push up. We could easily push back up here again. This is URA, the ETF. We could easily push back up to like 23 and a quarter, maybe a little higher even. But we need to put in a new high. We need to reclaim the 200 exponential. I mean, we had a hard buy signal here and basically just rolled over. So it's not unrealistic to think we just get another one and just roll over again. We also don't have any kind of divergence or anything showing up. Doesn't look particularly great. All right, let's look at some cryptos. All right, so here is our Bitcoin futures chart. So Bitcoin futures chart, let's actually start on the 4-hour. Because it is important. I've been paying attention to, I watch obviously some of the shorter time frames as well. The 4-hour on the regular spot market, we actually like broke above the 200 exponential and simple. Obviously here on the futures, when it opened up, we pushed up and essentially are getting rejected there right now. If we reclaim the 200 exponential and simple and consolidate above them, this will start looking bullish. It's going to start look like we're at least going to get like a measure move breakout to the upside. God damn. I feel like this thing is acting a fool right now. Give me like 2 seconds. Talk amongst yourselves. Don't know why. Like for some reason, I don't know. TradingView has just been acting a fool lately. Yeah, it's so weird. It's definitely TradingView. Because all my other windows are completely fine. God damn, you TradingView, you piece of shit. Ah, hate TradingView. Gotta be kidding me. So damn annoying. So damn annoying. All right, probably just gonna cut this one short today. So I don't feel like loading up all my damn charts again and going through the whole thing. I don't know what the hell is going on here. I'm gonna try to update it again and see what's up. But this has really been pissing me off. Okay, so Bitcoin futures chart. All I did right there was clear my cash out. So, because I thought maybe that's why I was running slow, but apparently I don't even know. It's got to be the most recent update on TradingView. Because my other windows, same browser, are completely fine. Didn't crash. Everything's fine with them. Literally makes no sense. Okay, so CME futures. I'll sort that out later. So here we are on the daily. Basically, we have broken above the 8 and 21. Had a slight gap up from the close. The most important thing to pay attention to here is, and I was talking about it with some of the group members, don't mind the drawing tools here. We had this descending trend line resistance, and we broke through it. And we had all weekend to get a powerful move to the upside, and nothing happened. I mean, we should have got a powerful breakout, should have got some kind of continuation, should have got like basically anything, and nothing happened all weekend. So if we know like institutional money doesn't really care about direction or price action or Bitcoin in general, they only care about making money. Why did the Bitcoin bulls not push up the price over the weekend? They either are weak, don't care, don't have any money. So this is our Bitcoin chart right here. We have very clear descending trend line. We had a little poke out the bottom. A little, oh my gosh, I can't think. A little spring. Came back, reclaimed it, pushed to the upside, broke out through the upside, and now here we are. Basically did nothing all weekend. Our measured move is the retest of the 200 exponential and simple. This is a move we were talking about last stream. Potential move back up to like 46 to 48,000. We were talking about 40,000 before that. So it's not unexpected by any means. This is what we would expect as we have broken down below the 200 exponential and simple. We would expect to move back up to them and then try to reclaim them. If we fail to reclaim them, they act as resistance. We would expect continuation into the bear market. So if we just go back in time, just for simplicity's sake, and we just look at a previous cycle, what it looks like when we have that move take place. Oh man, it zoomed me all the way forward. Just not my day. So this is our breakdown from 20,000 in 2017, 2018. So we break down, we bounce the 200 exponential and simple, try to reclaim it as support. It fails, we break down through it. We come back up, retest it, reclaim it for a little bit, acts as resistance, and then we break down from it. We can't reclaim it and stay above it. Break down, see continuation, put in a new low. We come back up, retest it again. We fail to get above it, retest it again, and then we basically start flatlining, and then eventually we just roll over. But that was the confirmation of the bear market when we couldn't reclaim that level. So that's what we're really being careful of. Again, we'll see that happen over and over again. Here we break down from 14,000. We reclaim it. We can't hold it. We break down, put in a new low, come back up, take out the previous high, but can't maintain it. Roll back over. That's our CVD low. And then finally we go into a bull market. Here we reclaim it, put in a new high, similar to what we did off that 14,000 level, but not on the macro. And now here we are back here. So the most likely move to take place, if we can get any kind of continuation, is to push back up to like 48, 50,000. Try to reclaim it. If we fail, bear market. If we succeed, and we can see continuation, maybe new highs is possible. But the market will tell us. And we know that, this is, the hourglass has already been flipped over. There's not a lot of sand left in it. We know we're at like the 4-year cycle period. We know that the rates and the yield curve inversion are getting ready to flip. We know that the stock market doesn't look particularly great. We know that money's about to get more expensive. We know that the economy is not doing particularly well regardless of what they tell us. We know there's inflation. So all these things combine together, and it's like, do you all of a sudden think that more money is going to flow into crypto and it's going to go parabolic? Or do you think it's more likely that money's going to flow out of crypto and it's going to fall? And then why? Because of all those reasons we talked about? Seems viable to me. But again, we let the market speak to us because, obviously we did have some bullish divergence here. Obviously we did break through a key level. Obviously we are potentially pushing up here. So we have to see what happens. We don't want to get greedy, but we also don't want to miss a big move. If we get back on top of the 200 exponential and simple, I will start getting very bullish on these markets when we start flipping it back over. I do like that we've already flipped 8 and 21 on the daily back over, but we could easily get a situation like this. This actually was flipped over green and then immediately rolled over, and we lost the green and it turned back red. But we haven't gotten a bunch of false alarms. This was a false alarm right here and then rejection. But every other time we've got quite a bit of follow through when the 8 and 21 flipped over. So not a ton of meat left on the bone right here, but somewhere around like 12%, 10%, somewhere around that. So, but probably better in some altcoins if we decided to play them. So we'll pay attention to those and go from there. Man, I really don't feel like loading up all these extra charts. Fucking TradingView. Hopefully it's something. It's got to be something between TradingView and the browser. Maybe just fighting with each other. I mean, the browser's fine though. It didn't crash. What did you ask me to look at, man? What was it? Atom, Algo, and Link. All right, here's Atom. Still looks fairly bullish. On the daily, it's on top of the 200 exponential, putting in higher lows. Basically, looks like it's just flagging out for right now. I mean, we've got a pretty clear resistance, up here. We need to get through that. So we got to really just see what happens here. I mean, the line in the sands are obviously the previous low and the previous highs. And where we at right now, we're right smack in the middle. So there's nothing to be had right here. And you could argue that this is really just, a horizontal channel, which I would agree with you. Because we see some clear interactions around this level for support and resistance. And here we are at that level. So, again, we're equal distance from the top and the bottom. I would give a slight favor to the bullish side on this. I mean, I don't know that I would be entering any positions right here, but arguably, if you were looking for a position, if we took out this low right here, you would expect it to move to the bottom of the range, so you'd want to be out of your position. But the real play would just be to play it back to the top of the range. So, I mean, that's a 16% stop loss on a close and a 40% upside on a close. So, I mean, it's 2.5 to 1, but those margins are so big. There's nothing here, in my opinion. If I was in a position, I would probably stay in it for now, but I don't love the idea of this. I mean, to tell you the truth, I like the idea of just de-risking right now. So if I was up on a position and I was in this, I would probably put a stop loss in place under the 200 exponential and simple and just lock in some gains just in case. But right now it looks bullish neutral. So that was Atom, and then what did you say? Link. So Link looks way worse. Well below the 200 exponential and simple. It's trying to flip the 200 simple back over. Man, there's so much junk on these charts. Let me just get rid of all that. And then, we have obviously like a pretty clear, basically like line in the sand down here. and a little something like this going on here. So again, we have a giant descending triangle distribution topping pattern typically. Obviously we break down from yellow, it's going to look really, really bad. If we break out from red, we just look at the previous peaks to see where it might run up to. So right now we're paying attention to this peak. So obviously we're at the bottom of the range. We see some very clear resistance above our head right here from these previous bottoms. And then we obviously have some other resistance along the way. So it's going to be a slog back up here. Does not mean it can't go back to like $24. It would be a nice move. But this does not look particularly bullish just as a whole to me. But again, if we just say, our optimistic target is 33% to the upside, stop loss like 16.8%. So again, 2-to-1 risk reward ratio, but the stop is so big. It's just not, there's no trades to be had. Really, most of the stuff, there's no trades to be had. They've already moved enough to the upside that they're not worth touching. And there's so much risk to the downside right now. I mean, if you just ran a stop loss that was tight and just wanted to, or you're already in a trade, that's one thing. But I wouldn't risk too much on these things. I wouldn't want to risk for a 2-to-1 risk reward ratio, 16% stop loss, in my opinion. That's just reckless. And then what was the last one? Algo. Okay, Algo, again, looks very weak. Well below 200 exponential on simple. Looks like it's rolling over right here. Yeah, it looks pretty rough. The move back up would be like $1.30 to retest the breakdown. But there's so much resistance right here. Was support now acting as resistance? We could probably try to do some kind of fib action. That looks pretty legit. Looks like it's trading pretty technically, so just remember, if you're trading this, you're trading against some pretty serious bots and algorithms. Some algos, so to speak. That was terrible. But yeah, that's very clear support right here. Obviously, we see some clear correspondence with these levels. Support and resistance in various places. So it looks like it wants to come back up and retest $1.30. Could very easily come back down to like 80 cents. Again, we're right smack in the middle of the range. Very dangerous place to be taking positions. And again, if you're up on these positions, I would be locking in gains or preparing to do so. It's not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Oh, you know what? I need to look at Nat Gas also, because I forgot to last week. So Nat Gas, basically, so we obviously entered into a nice bull trend back here at like $2. Had a crazy run up to like 650. Had a pullback to 200 exponential and simple. Put in a little W, double bottom. Had the breakout to the upside. Now it looks like one of two things is going to happen here. Obviously, it's going to go up or it's going to go down. So you're welcome. No, I'm just kidding. We're either going to come back up and threaten the highs, or, we're going to find support on 200 exponential and simple, consolidate, and then start threatening the highs and start forming a micro uptrend inside of the macro uptrend and then try to threaten the highs. Or, this isn't going to hold and we're going to come back down. So the key levels to pay attention to, again, we see sort of a ascending support kind of like here. We see obviously some resistance showing up right here. So we basically have like a little flag action going on. I would expect us to trade inside that range. And then, once we get a break in one direction or the other, probably going to see continuation. Would have to give it a bullish bias since it is in an uptrend. But it also has had a crazy run. So looks like it's trying to top out right here. Now we'll see if that actually happens. I mean, a lot of this stuff is going overseas right now. So, to tell you the truth, with oil and Nat Gas right now, I mean, I have a bullish bias towards them because of the technicals on a longer time frame, even though the shorter time frames don't look particularly great. The fact of the matter is, like, fundamentally right now, it's hard for me to believe that they're just going to start going down. Just because of, like, the overall environment right now and, like, shortages and everything going on with Russia. Mother Russia. So, yeah, I mean, overall, you would have expected this area to hold after the breakout. Maybe it still will. But again, right smack in the middle of the range. I mean, you could tell that markets have no clue what's going on right now. Everything is like in the middle of the range with no momentum, no follow through. Everybody is just like finger on the trigger, ready to buy or sell. They're just like, do I buy now or do I sell now? Do I buy now or do I sell now? Nobody knows. And that's where that volatility comes from. And, I used this metaphor last week or in the group or something. Think about that old trucker movie with Sylvester Stallone, that arm wrestling movie. I can't remember what it was called. It was so terrible. But he's a truck driver and he's like a, badass arm wrestler. And just picture that. Just two truck drivers arm wrestling, and it swings to the left, it swings to the right, bullish, bearish, and then eventually one of their arms snaps or their muscle gives way or whatever happens, but then it goes. But right now we're just seeing that kind of oscillating between, Stallone or random juiced up other truck driver. But we don't know which way it's going to break. We don't know which way any of this stuff's going to break. We can kind of root on the we kind of want to root on Stallone because he's the star of the movie. Want to root on the bullishness. We have favor towards him, but, maybe this is one of those stories where, he has to lose and then come back. And then, the other guy wins. Nat Gas breaks down. Bitcoin breaks down. Stocks break down. Whatever. But, Stallone's the good guy. He's the bullishness. He's the easy money. He's the easy pick. The other guy, the antagonist, sometimes you got to root for the bad guy. But overall, I think most of these markets just don't know what they're going to do. And I think if there was ever a time, well, obviously other than the top, when we were calling out that we were expecting big pullbacks, if there was ever a time that we want to be careful in these markets, this is it. The most important thing, protect your principal. Just to make a specific point of that, and then we're going to call it here actually. Just to make a specific point of that, I've talked about this before. If you have a drawdown versus a gain, I have this as like a chart on the channel as like one of the tools. But essentially, just for simplicity's sake, real quick, in a horrible way, I'm just going to illustrate my point. So if we have $100 and one of two things is going to happen. We're either going to be right and we're going to have a 50% move to the upside, or we're going to be wrong and have a 50% move to the downside. So if we're right, our $100 is going to turn into $150. But if we're wrong, our $100 is going to turn into $50. Either way, the move is 50%. So we're right, and our $100 turns into $150. We're wrong, our $100 turns into $50. Choose your own adventure. Okay, coin toss. We don't know which one's going to happen, but we bet our 100. Half the time we're right, half the time we're wrong. That's fine. So now let's say we have the same exact thing happen again. But this time, say odds play out. The first time we were right, and then this time we're going to be wrong. The first time we were wrong, this time we're going to be right. So now that $150, again, has a 50% probability of playing out. So you think, oh, okay, that's cool. It's just going to go back to being 100, right? Because 150 and then you lose, you go back to 100. You lose the 50 you gain. But that's not how it works. Because it's a percentage of a larger number now. So when we lose 50% this time after gaining 50%, we actually go down to 75. So we're net loss now on this one. So, just for, obviously, it's, this is our little flow chart. And then this is our little flow chart. So now we were right for the $50, or we were wrong for the $50 the first time, but this time we're right on a 50% bet. So now this goes up by 50%. So we go back to 100, right? No. We go back to 75 because 50 plus 50% of 50 is another 25. So we go to 75. So essentially, the most important thing to pay attention to is, and this is a horrible, horrible illustration, but it's super basic that even a child can understand it. This is why this little illustration right here, this tiny little flow chart for kindergartners tells us right here, the most important thing to do is protect our principal, protect our capital. Because we could be right for 50%, but if we're wrong for 50%, we're still down 25%. If we're wrong for 50% and then we're right for 50%, we're still down 25%. So what is the most important thing is to not take losses. The most important thing is to not take losses. Because the losses are what hurts our account. The gains are good, but the losses easily outweigh the gains. The losses are bad, and the gains don't even come close to making up for those gains. So that's our flow chart for today. Welcome to 3rd grade flow charting. Hopefully now you understand why I'm always talking about it's so much more important to protect our principal, protect our capital, than it is to take these risks. And why it's so important to take probability based on technical analysis so we have a high chance of succeeding in our trades. Position sizing is important because we want to make sure that we get a chance to make a bunch of trades so that we can let the coin toss go in our favor. And then, of course, risk management, or risk reward ratio rather, to make sure that when we take these trades that the benefit far outweighs the risk. So even if we are wrong, when we're right, we win exponentially more. So if we master those things and then control our emotions or psychology, make intelligent investments based on technicals, not Cathie Wood fundamentals. Because remember, we would rather be, a month early than a day late. So, Cathie Wood, she might be right eventually, but in the meantime, she lost 75% of her money, or 50% of everyone's money. So in the end, most important thing, protecting our principal. After that, the gains come easy. We know that because all we do is, you know how it works. We avoid the big losses. The little wins and the little losses cancel each other out. And the only thing left is the big gains. And we're all about those gains, motherfuckers. But that's it for today. So I'm going to jump in the chat real quick if you guys have any other questions or whatever. And then we're going to call it because TradingView is pissing me off. And we nailed a couple of charts here. This will be the shortest live stream ever for the record. So we're setting records. Oh, yeah. You're welcome. M. Hoff says, already have positions in each. Could sell now at a profit. Honestly, the momentum is sort of to the upside for now. So what I would do is probably just make sure I have a stop loss in place to protect myself from giving back my gains or losses, and continue to just trail my stop loss to the upside. So let the market take profits for you if we have a pullback. If we don't, you just keep making money. That's what I would do. But obviously, it's not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Be in the middle of the range is why I asked for a quick look. Thanks for confirming. It's a coin toss. CW says, so you were comparing the 2-year and 10-year. Have you looked at them with SPY? Does it show a correlation? Like for when we go into recessions, or I'm not sure exactly what you're talking about. have I looked at them for SPY to see a correlation? I mean, like with market crashes, is that what you're talking about? I mean, we can pull it up real quick. We don't really have to look at them for market crashes just because, I mean, we know when the market crashes took place, but yeah, we can definitely look at it. So this is the SPY monthly. So what? I mean, we know when the recessions were, right? 2019 was one. That was a massive sell-off, right? The one before that was 2008. So that was right here. So that was obviously a big market sell-off. And then the one prior to that was 2000. And that was a big market sell-off. So we know that the recessions lead to, from peak to trough, 50% in 2000. 2008 was 57% sell-off. 2019 was a 36% sell-off. So if we figure somewhere between 36 and 58%, so I mean we could say 40 to 55% sell-off. And we know obviously we have the 200 exponential and simple right here, assuming that we already topped out, which we don't know that we did. You know, somewhere around like a 45% sell-off would be basically a retest of the lows at like 263 or 2600, depending on what you're looking at. Doesn't seem unlikely that we would find support at basically this double bottom right here, and then also the 200 exponential and simple. That's a 48% move, and that basically comes in right at 245 or 2,450. So that's what I would be looking for if we got a big dump. You know, but again, that might not happen for a couple months or even a year, but we know it's coming. We just don't know, is it going to be a regular old recession? Is it going to be a V-bottom recession? Is it going to be a depression? Is it going to be a global meltdown? Is it going to be a war? I mean, we don't know that stuff, but we know what the charts are telling us. It's imminent. It's coming. Maybe in a couple months, maybe in a year. For sure, CW, definitely. And, you know, we could look at like the SPX or like Dow Jones or something like that, and we can trace it back to like the 80s and see that each of these recessions corresponds, you know, and obviously it affects GDP. It would, you know, reflect in like CPI or inflation numbers, all these things. This what is that? The Shin Chan 2 says, what do you think will happen to weed stocks? You still hold Tilray? I mean, I still have small positions in the pot stocks for now. You know, and I've been slowly building positions in them, in Tilray, ACB, and Hexo. But the truth is, got to be real careful because they are by far the weakest sector, you know, in anything. I mean, with the exception of maybe like, no, I mean, they're realistically, like silver and pot stocks are probably like the worst things right now. Like long-term chart wise, other than like Intel and MicroStrategy and like a couple of those like XRP. You know, even XRP is technically better. But the fact of the matter is that those pot stocks are real companies and they have like, you know, book value of assets, you know, and obviously they're publicly traded. So we can look at shares outstanding. We can look at their debt. We can look at their assets. And then just a couple simple calculations. We can basically just subtract their debt from their assets. And then we can compare that to the valuation that the market is giving them based on market cap compared to like their actual book value of the stocks. And it's been a while since I looked, but Hexo, Tilray, and Aurora are all below 50% of their actual like book value. So in my opinion, that's finding something that's underpriced. You know, and they're underpriced because they've been hated for what? I mean, 3 or 4 years now. Everything else has been going to new all-time highs while they've been just getting absolutely crushed. So you could argue that they were overvalued previously and that was a bubble and it popped and that's why they're so low. But, essentially, if you were a company and you say, okay, I'm going to buy Tilray, they're trading at 50% below book value. So I'll pay them halfway between that and, fair market value. Like halfway between their actual market value now and their book value. You basically buy up a company that's established, that has a brand, a name, and everything. You get it at a discount. Everybody wins. So, something like Hexo, that's more likely to happen. But honestly, they're also beat down at this point in time. I mean, Hexo's like 50 cents. That's so wild. Tilray and ACB are like around $5 a piece right now. I mean, give or take a couple dollars. I mean, it's not unrealistic to think that somebody swoops in, with a few $1 billion and just buys them up. Similar to like that Activision Blizzard deal that we saw, which may or may not go through. Probably not going to ever happen. But, what happened with that? It's, the stock instantly shoots up 50% or whatever, 100%. Which would essentially just be them going back to like book value or fair market value. So we'll see. We'll see what happens, man. It's like anything though, you build a position slowly and responsibly. If it doesn't work out, that's fine. If it does, we do extremely well. And, if pot stocks ever go back into a bull market, and I mean, Tilray's all-time high was like over $300. So if you buy the thing for $5 and it goes back to 300, that's like crypto gains. I think Hexo's at like 50 cents right now, and its all-time high was like 30 something dollars. ACB, I can't even tell you off the top of my head. But again, massive potential there. Massive potential. But you got to be responsible, and you got to be prepared to hold them for years if possible. So, that's not really in my trading account like short-term scalps. That's more like long-term speculative investment plays. But I honestly believe in the future of cannabis as a whole. Honestly, just because government's going to need taxes. And it wasn't that long ago that alcohol was illegal and pot was legal. And I have a feeling that, the government wants to get their hands all over it. Same way they want to tax crypto and get that money. They want to tax cannabis and get that money. The easiest way to do that is make it legal. So I think it's just a matter of time. And it's going to be a while before it's legal federally and in all the states. So it'll be forever before American companies could actually be listed on the stock exchange. So one would reason that the Canadian pot stocks, the bigger names, would do well. And the only reason I'm leaving off Canopy Growth and some of the others is like they're still trading way higher than their book value. And if we're going to argue that we're looking at them as a value play because they're so beaten down, the fact that it's trading well over its book value takes away a lot of that argument. So we could say it's undervalued based on multiples, but we can't say it based on like actual asset to debt ratio and like, fair book value. Best advice for a recession? I mean, I can't really give you like financial advice or anything. I mean, the most important thing, in my opinion, that I do and make sure is, that I have enough money to cover my bills for a long amount of time. Like, think about the worst case scenario. If you and or your spouse lost your job, do you have enough money to pay all your bills for 6 months or a year? Do you have multiple sources of income? Are you going to be okay, in a situation where something like that happens? If not, I would be more focused on that. I would be paying attention to high interest rate debt and making sure that I paid that down, like credit card debt and things like that. I would be less concerned with, if you have a mortgage at 3% for 30 years, I wouldn't worry about paying that down. That's great. That's the cheapest money you'll probably ever get, until rates go to zero again, and then you can get it cheaper, maybe. Or maybe they break out and we never see 3% again. So, I mean, the same way companies need to shore up their balance sheet in uncertain times, I would, as a, personal person, do the exact same thing as well. I wouldn't be taking on extra debt. I wouldn't be buying frivolous things. I would be paying down high interest, debt. I would just be a little tight, a little more responsible, a little more cautious going into the future, until we see how some of these things unravel. Because there is a possibility this all just works out and everything's gravy and the world just goes back to normal and it's like none of this bad stuff happened and we go to new all-time highs and we just go back into another cyclical bull market. Everything's gravy, easy money, sunshines and rainbows. But like, does that seem more likely, or does it seem more likely that there's some storm clouds ahead, whether it's stock market crash, crypto crash, interest rates rising, Fed loses control, inflation out of control, deflation, GDP bust. There's just so many it just seems there's so many more things like as headwinds than tailwinds. It just makes sense for me, honestly, to be cautious right now. And if you're old, you should be extra cautious because you don't want to lose money if you're close to retirement or already retired. And if you're young, you have your whole life in front of you to invest. So if the markets crash, that's best case scenario for you because then you just have, extra time to just put money in at low values. So either way, in my opinion, there's very little upside potential compared to the downside risk, in my opinion. Obviously not financial advice. Predictions for tomorrow, Honkiness says. I guess it depends where you're located, but I would say probably like high of 55, low of 33. Are you talking about weather? Partly cloudy? Well, let's see. We had a decent close going into Friday, but it was pretty indecision-y. I think volatility, but we'll see what happens, man. I don't love how these markets look. One day ahead, it's hard to make a prediction. We closed decent on Friday, so we're less likely to see continuation to the downside. If we would have closed poorly on Friday, I would say Monday's probably going to look terrible. But I would say it's probably just going to be indecision. I think by the end of the week, though, we'll have a pretty good idea what's up. I think at some point in time, we're going to get a push up this week, and then we'll see what happens. If we get a push up and it fails, I'm going to be very bearish from here on out, based on technicals. If we get a push up and we reclaim some of these levels, consolidate, the more time we go sideways, the better, in my opinion. But again, the hourglass has been flipped. The sand is slowly draining out. We can count the grains of sand left based on multiple indicator oscillators. So if energy prices keep rising, if we continue to see the 2 and 10 year fast approaching each other, it's the faster those two things happen, the faster we are towards, the end of whatever's happening right now. So yeah, for sure, man. Definitely. Always glad to share with you guys. Appreciate everybody tuning in today. I'm going to wrap it up there. It's kind of a short one today. Obviously, I'm a little bit sick. And then I'm also a lot of bit sick of TradingView being a piece of shit. I will do this update and hopefully that will solve this. It's going to be real annoying if this is like a regular thing. I will maybe even download a different browser. See if that makes a difference. I know a couple other people had told me they had issues with it. I'm not having any issues with it on any of my other... on my Mac, but I'm having issues with it on my PC, and I'm not having any issues with the browser on the same computer looking at other windows. It's only TradingView and this browser on this computer. So I don't know what the hell is going on here. And obviously I keep a shit ton of windows open, but it's annoying not to be able to look at like 50 assets in rapid fire motion or 200. Depending on the day. But all right, that's going to do it for today. Make sure you guys like and subscribe, share with your friends, grab your dog, smash your keyboard, hit the like button, whatever, all that good stuff. Are PCs really computers? More like PS at this point. Piece of shit. Pissing me off. Yeah, that's it for today. So that is our Sunday evening market look ahead on February 6, 2022. It is 9:30 p.m. Eastern Standard Time. I am Crypto Trend Trader. That is our market outlook. Everybody protect your principal. Remember what I said. Remember that little sweet, sweet flow chart. Every time you make an investment, a purchase, a speculation, whatever, just remember that little flow chart. That sweet, sweet 50 up, 50 down, 50 down, 50 up. Either way, you end up at the same place, down 25. But that's it for today, Crypto Trend Trader, and I'm out of here. Peace.